Let's now look at illustration number 20. On 1st January 2021, PG Limited subscribes to convertible preference shares of BG Limited at rupees 100 per preference share. All right, PG Limited is basically the holder. It is subscribing to the preference shares that have been issued by BG Limited, which is the issuer. All right, so BG Limited has issued one preference share for rupees 100 each. The preference shares are convertible in the ratio of 10 is to 1, which is 10 equity shares for each preference share held. On a fully diluted basis, PG Limited is entitled to 30% stake in BG Limited. So what the question is basically stating is, if let us say all the preference shares are converted into equity shares, PG Limited will be entitled to 30% stake in BG. After conversion, PG Limited is going to have 30% ownership in BG Limited. Now, before we actually read the subsequent paragraph, let us actually analyze the first paragraph itself in a little further detail. If you notice, PG Limited has actually purchased PG Limited, which is the holder of the instrument. It has actually purchased one preference share at rupees 100. All right, it has basically paid rupees 100 and it has obtained one preference share. This one preference share is going to get converted into 10 equity shares in future. All right, this is going to get converted into 10 equity shares in future. Can I indirectly basically say that PG Limited has actually purchased 10 equity shares at rupees 100? Indirectly, it has purchased 10 equity shares at rupees 100, because although it is receiving one preference share today, these preference shares are going to eventually get converted into 10 equity shares, which means that PG Limited has basically paid 100 rupees for obtaining 10 equity shares, which means that it has basically paid rupees 10 for every equity share. It has basically paid 10 rupees for each equity share. All right. How have I arrived 10 rupees for each equity share? One preference share, it has purchased at rupees 100. Each preference share is convertible into 10 equity shares, which means that I have effectively paid, PG Limited has effectively paid rupees 10 for every equity share. This rupees 10 is often referred to as conversion price. It's often referred to as conversion price, which means that I have effectively paid rupees 10 per every equity share. Now let us actually read the second paragraph also in this context. If subsequent to the issuance of these convertible preference shares, after the issuance of these convertible preference shares, if BG Limited issues any equity instrument at a price lower than 10 per share, all right, what the terms of the instrument are saying is, if let us say after these convertible preference shares, BG Limited is actually raising capital by issuing equity shares in the market. If BG Limited is actually issuing additional equity shares in the market and is raising money, and if the issue price of such share is less than 10, how is this 10 rupees calculated? This 10 rupees benchmark is calculated, is the 10 rupees benchmark that is calculated is nothing but the conversion price for PG. PG has effectively paid 10 per equity share, and what we are saying is, if BG is issuing equity shares at a price which is less than 10, which is less than what PG has paid, if BG is issuing shares in the market at, let us say, rupees 8, all right, this means that it is actually issuing shares at a price less than what PG has effectively paid. PG Limited has effectively paid 10 per share, and BG is making a fresh issue of equity shares in the market for public to subscribe to it at rupees 8 per share only. If you actually think of it, PG has actually paid 10 for every equity share, and BG is now issuing in the market at only rupees 8 for every equity share. All right, so obviously PG is actually at a loss. All right, PG has actually paid 10, whereas BG is now issuing the same shares in the market at a lower price. It is issuing it at a lower price of rupees 8, which means that PG is obviously at a loss, and therefore the terms of the instrument are saying that the conversion ratio will actually be changed to compensate PG Limited. All right. So if in a circumstance where PG Limited is issuing shares in the market at a price which is less than 10, what we are telling is, PG Limited, don't worry, you will not be at a loss, because we will change the conversion ratio. We will increase the conversion ratio. The conversion ratio is, let us say right now, 10 is to 1. What we are saying is, the conversion ratio, instead of being 10 is to 1, let us say it is going to be 12.5 is to 1. All right, I'm going to change the conversion ratio from 10 is to 1 to 12.5 is to 1, which means PG Limited is actually going to receive 12 and a half equity shares for every one equity share. All right, they will receive 12 and a half equity shares for every one equity share. And what we are actually saying is the conversion ratio will be changed to compensate PG Limited for its dilution in the stake below the expected dilution of 10 per share. All right, so the terms of the instrument state that the conversion ratio is fixed at 10 is to 1 generally, but if let us say BG Limited is issuing shares in the market at a price lower than 10 rupees, then the conversion ratio will, let us say, will be increased to 12 and a half. It will be increased to 12.5 is to 1 to compensate PG Limited for the dilution in its stake. All right, so we are actually going to compensate PG Limited for the dilution in its stake. Now the question is, examine the nature of financial instrument. All right. Now over here, the conversion ratio is actually changing. All right. From the viewpoint of BG Limited, if BG Limited has an obligation to issue 10 shares for every preference share, it has an obligation to issue 10 fixed equity shares for every preference share. But in certain circumstances, that conversion ratio might change from 10 is to 1 to 12.5 is to 1. It will change from 10 is to 1 to 12.5 is to 1. Of course, I've cooked up these numbers because 12.5 is to 1 is the number conversion ratio if the shares are issued at rupees 8. All right, if the shares are issued, let us say at rupees 7, the conversion ratio will be further increased. All right, so if the market price at which the shares were issued by BG Limited keeps falling, then to compensate PG, I will keep increasing the conversion ratio. All right, if the market price at which I'm issuing the shares is going to keep reducing, I will keep compensating by increasing the conversion ratio. The question is this supposed to be regarded as an obligation to issue a fixed number of equity shares, or is this going to be regarded as an obligation to issue variable number of equity shares? Because the conversion ratio is actually varying. It can be either 10 is to 1 or 12.5 is to 1, or it can be 15 is to 1, and so on. All right, since the conversion ratio can vary, are we going to treat it as an obligation to issue a fixed number of equity shares, or are we going to treat it as an obligation to issue variable number of equity shares is the question. The answer is we are going to actually treat it as an obligation to issue variable number of equity shares. All right, because at any point in time over here, unlike the previous example in illustration number 19, the example was purely to actually compensate HT Limited for any bonus issue that is happening. All right, bonus issue is an issue where you do not receive cash, but your voting ownership is actually changing. All right, you're not receiving any additional cash, but your ownership is changing, and therefore the conversion ratio over here was going to change from 1 is to 1 to 2 is to 1 to compensate HT Limited. To bring them on par, we were actually we were changing the conversion ratio with regards to HT Limited, whereas that is not the case over here. Over here, there has been a fresh issue of equity shares and there was an inflow of cash. All right, so the change in conversion ratio over here is not actually purely to protect the voting percentage, but it is to compensate PG Limited. If the share price falls, we are issuing a higher number of equity shares. All right, if let us say the share price falls to 8, we are going to issue 12.5 equity shares instead of 10 equity shares. We're going to issue a higher number of equity shares if the share price falls below. If we are issuing shares below rupees 10, which means if we are issuing at 8, we will actually give 12.5. If we are issuing shares in the market at, let's say, 5, we will actually increase the conversion ratio to say 20 is to 1. All right, if we are issuing the shares in the market at rupees 5, the conversion ratio will be 20 is to 1. So we are actually altering the ratio based on the price at which the shares were issued in the market. So if you actually think of it, this example is exactly the same as, let's say, illustration number 13, where the number of shares that we were going to issue were changing depending on the change in the market price per share. All right, if the market price falls, we were issuing a higher number of equity shares. If the market price was rising, we were issuing a lower number of equity shares. So here also, if you think of it, what is effectively happening is when the market price is falling, we are actually issuing a higher number of equity shares to PG Limited, and that is going to be regarded as issuing a variable number of equity shares. All right, and therefore we will not classify this as equity. We will be classifying this as a financial liability. All right, since the conversion ratio is actually changing depending on the market price per share, depending on at what price we are actually issuing the shares in the market, therefore this is going to be regarded as issuing variable number of equity shares. All right, since the conversion ratio increases when the price falls, basically PG Limited is not absorbing all the profits and losses. PG Limited is actually being compensated for any losses. All right. Remember, one of the characteristic of equity instrument was that the holder or PG Limited should be exposed to the variability in the net assets. If the net assets increase, PG is supposed to actually get benefit out of it. If net assets decrease, PG Limited is supposed to take the brunt of it. Over here, when the price per share is actually falling, we are actually compensating PG Limited for the by increasing the conversion ratio. Yes, that compensation is only when BG is issuing the shares in the market at such a lower price. All right. Generally, if BG Limited is not issuing any shares and if still the price falls, then of course PG Limited is not getting compensated. But PG is getting compensated if the shares are being issued at such a lower price. And that is also a violation of the fixed number of shares test. All right. So it is going to be regarded as the entity is issuing variable number of equity shares, and hence we are going to classify this as a financial liability. All right, let's actually read the solution. The variability in the conversion ratio is basically underwriting the return on preference shares. It's basically ensuring that PG Limited gets a minimum return on the preference shares. It's basically restricting the loss that PG Limited is taking. All right, if let us say if the conversion ratio would not have changed, ideally PG Limited would have taken the loss. But because the conversion ratio is changing, what we are doing is we are safeguarding PG Limited from any losses. We are underwriting the return on the preference shares, and we are not just protecting the rights of the convertible instrument as it was in illustration number 19. In illustration number 19, it was being done purely to protect the rights, whereas over here we are ensuring that the return that PG Limited actually earns is safeguarded vis-a-vis the other equity shareholders, and hence this is going to be regarded as an obligation to issue a variable number of equity shares.